Asset class correlation is an element SMSF members must always consider when managing their fund portfolio. Anthony Murphy and Michael Houghton from Lucerne Investment Partners is with me today to discuss the importance of this issue. Welcome to you both.
Thanks, Darren.
Thank you, Darren.
I might just start by asking why minimizing asset class correlation is so important.
Well, thanks, Darren. The primary reason is you're able to diversify away from returns that are going to influence your portfolio. So if one market was to go in one direction and you're not correlated to that, then your returns are able to continue in the direction that you would like as a group, as an allocation overall across the portfolio. So if you're targeting a return of 7 or 8% per annum, and you've got a large allocation to equities, for example, they're all going to go the same way at the same time, which is a high correlation. So you want to try and minimize as much of that as you can. And one of the ways is portfolio asset allocation and diversifying assets within that allocation.
Now, Lucerne Investment Partners has actually got a product to provide a solution to ensure a segment of a portfolio has low correlation with equities, which is an asset class, as we all know, that's very popular among SMSF trustees. Can you tell us a little bit more about it?
Sure. Well, Lucerne has a fund called the Lucerne Alternative Investments Fund. Its primary objective is to invest in the alternatives asset space. A lot of people hear the word alternatives and probably don't fully understand what it comprises. And the simplest way that we look at it is that equities, bonds, cash are your traditional asset class. Anything that doesn't fit within that is defined as an alternative investment. So that could include things like private debt, private equity, real estate, digital assets, commodities, etc. So there's a lot of breadth to and a lot of investments that you're not participating in if you don't actually have alternatives in your portfolio. So the Lucerne Alternative Investments Fund does have an allocation across all those asset classes, and it also, as a result, is able to achieve very strong, what we call risk-adjusted returns. So for the return that you're getting, the risk you're taking is quite low. For example, with our fund, with the returns in 21 and 20 being above 20% for both those years, the risk was sitting at around 6 or 7% compared to the equities markets with their volatility or risk sitting somewhere between 12 and 14%, depending on which year you're looking at.
That would provide a lot of downside protection, wouldn't it? Which is very important.
Yes, and the downside protection is achieved through not only the allocation to alternative assets, but through the way that we've structured the portfolio, how we weight it, the decisions that we make on what assets we want to allocate to at what time. And what you do see then is that the returns, as each month unfolds, as various things take place in the world markets, in macroeconomic, geopolitical issues, that the fund has underlying investments that will continue to perform as others may not, but overall it provides a solid, stable return profile for the fund.
Now, recognizing opportunities for the fund and balancing the portfolio within the fund is obviously very important. How do you recognize an emerging alternative asset, and how do you know when to buy into it and when to sell it off?
Yeah, I might take that one. So it's a great question, Darren, and we obviously don't have a crystal ball, but the way LAIF's investment committee operates is we do take a top-down approach. So we consider the macro environment first and foremost, and then based on our view of the macro environment, we take into account thematics that we believe are emerging in the market that instill tailwinds, and then we look at thematics in the market that potentially have headwinds. And then once you identify those thematics that you wish to own and the ones you wish to avoid, particularly on the ones we wish to own, we look at, using that word again, what's the best risk-adjusted way in which we want to own those assets. So a couple of examples around that over the last couple of years would be resources. You know, we identified in early 2020 on the back of COVID that we felt the resources market was going to rally and rally quite strongly. We could see that inflation was probably going to stick around on the back of the stimulus that was provided to global markets at the time. So we went on our merry way to really analyse the resources space, identify experts within that space that had good quality track record, And as a result of that, we actually seeded a new resources fund back in April 2020, which for our investors is annualised 64% per annum over that period of time. Now, in terms of our view on resources, we actually still think that thematic's got a long way to play out at the moment. We think we're potentially at the start of a bit of a super cycle in that space. And so we're not looking to exit that strategy anytime soon. But as we start to see that thematic change and die down, we will start to actively reduce that exposure. And we can give you another live example where that happened not too long ago. Again, in early 2020, when COVID occurred, we looked at a thematic in terms of it was going to be a lot more individuals at home in their households, potentially a lot of spare time on their computers. And we thought, well, what's an emerging asset class in that space? And that was digital assets, cryptocurrency, blockchain, DeFi. And so again, in what is quite a complex investment strategy, we identified a group in Melbourne that we felt were experts in the space. We were the very first institutional investor in their fund in February 2020. It was at least another 12 months later to really the broader market started talking about digital assets and crypto. That fund did extraordinarily well for us in a short period of time. It was sized appropriately from a risk perspective, 1.5% of the fund, but it did go up 4 times in that year. And then when the market started getting, there was hubris in the market regarding this asset class, we took the view in mid-2021 to start reducing our allocation there, as the hubris was absolutely evident. And we actually stayed within the asset class, but we moved to a different strategy with the same manager in digital assets that allowed us to more or less make a fixed income return in that space, and that's performed incredibly well as well. So it's how you actually own that asset class as well, which is just as important as defining the theme itself.
Anthony, you did mention allocation to resources. Do you actually look at resources from the point of view that there are sub-asset classes that you have to invest in and out of as well during that portfolio management process?
Yeah, absolutely. So I did sort of box resources all as one there, but if you look at the underlying portfolio in LAIF at the moment, we actually have 3 separate resource strategies from the current 15 strategies that LAIF's managing. One of those is in precious metals and gold. So we're focusing on silver and gold in that space, which historically has been quite a good hedge against inflation. You're really starting to see that come to fruition at the moment because inflation is not transitory, as central banks wanted us to believe last year. No. It's far from it. In addition to that was the global resources manager I mentioned before, that is going into a lot of the sort of the precious metals, the lithium plays, the EV space, electric vehicles around the world. So that's a thematic we supported there, and that's more in global equities. And then finally, we've invested in a convertible debt structure in the resources space, where this manager is able to actually go to listed companies or private companies in the resources space, provide them with debt, but has the ability to participate in equity upside should that company perform well. If it does not, the debt is repaid. And so there's 3 different strategies that we looked in that resources basket as a whole. So our resources allocation across the board at the moment would be just shy of 20% across the whole fund, but it's held through 3 very different strategies to really dial down that volatility in the fund, and that's allowed us to protect downside risk, and that's one of the main drivers as to why LAIF has particularly performed so well in the last 2 years. We've been able to avoid large market drawdowns.
Okay, to bring it back to an SMSF context, how can the use of the LAIF fund allow SMSFs to outperform other types of funds in the industry?
Yeah, so to that point there, it's really on protecting capital when markets dislocate. So if you go back to Warren Buffett's rules of investing, what's rule number 1? Don't lose capital. What's rule number 2? See rule number 1. And so if you go back to February, March 2020, when global markets dislocated and fell circa 30% or 40% at its intra-week high, LAIF over that same period was down 6%. So we're able to protect that capital, then compound off a much higher base. And, as Einstein said, compounding is the 8th wonder of the world. And so when you're thinking about it from a portfolio allocation perspective, if my equity basket is under pressure and causing significant drawdowns in the portfolio, Well, then Leif's over here actually providing sort of some complementary support to that. Our next big stress test was in January this year, when the market woke up at the start of this year and thought this was all, a little bit crazy. We saw that dislocation again. Equity markets here were down about 6.3%, and Leif was actually up 0.8 in January. So they're two really live periods in the last 2 years where markets have had significant short-term drawdowns. We've been able to stem the tide, and then again, repeating myself, but we're compounding off that higher capital base.
And I think, Darren, if I can just add to what Anthony said there, for self-managed super funds, one of the key things is actually accessing alternative investments. It's really difficult to get into some of these investments unless you're an institutional or wholesale investor, or you've got minimums of $500,000 or $1 million, $500,000 or $1 million that you need to actually be a participant. What Leif, the Lucerne Alternative Investments Fund, does provide is it's a retail product. So you don't have to worry about being a sophisticated or wholesale investor. $25,000 minimum, monthly liquidity, and the accessibility, of course, that provides self-managed super funds is really important into an alternative space that is typically reserved for the future fund or industry super funds.
I think what's really also important to self-managed super funds is obviously many which are in the pension phase and they're requiring that annual minimum pension payment. Yes. In a normal world, it's 5%, but it's less than that at the moment because of COVID. What Leif has the ability to do is also pay distributions on an annual basis. Last year the fund paid a 10% distribution to investors, so we do realise returns along the way and pay them out accordingly, and that's why it's just another good diversifier in the portfolio.
Look, thanks again for your time today, both Anthony and Michael, and for those insights into the fund there. Thank you very much.
Thanks for your time.
My pleasure. Thank you.
Now, if you would like to find out more details about the Lucerne Alternatives Investment Fund, please stay watching now.
Hello, everybody, and thank you for watching our interview with Darren Tyson-Chan. My name's Michael Houghton. I'm the chair of the Lucerne Alternative Investments Fund Investment Committee, and with me is Anthony Murphy, who's a member of the Investment Committee for Leif. We've taken the opportunity to put together another video to expand on some of the topics that we discussed with Darren, and I'm just going to introduce in a bit more detail some of the things that I mentioned. In particular, Leif is a retail fund or a registered managed investment scheme, as many of you would know it. It has the ability to accept investments from as little as $25,000. Now, what's unique about that is, of course, how else does a self-managed super fund get to invest in alternative investments if it doesn't meet the sophisticated investor test? This is the way you get to do it. I mentioned in the interview with Darren that in particular, alternatives are an asset class that are getting a lot of traction, a lot of interest. Many people are wanting to invest in it, either don't know how or can't access it. One of the things that Leif does provide you is the opportunity to access alternatives. Alternatives, as defined by the investment market, are typically anything that are not equities, bonds, cash, and for our purposes, property. So what does Leif hold, or what sort of alternative investment classes does it participate in? It varies. We're very fortunate, given it's a fund of funds, that we can go across a spectrum of assets within the alternatives universe. This can include precious metals or gold, cryptocurrency and blockchain and DeFi, to hedge funds, CTAs or commodity trading advisors, which are systematic trend funds, to volatility funds, etc. So there's quite a few different things that we can invest in. And in addition to that, you've got your more commonly known, such as private debt and private equity as well. I mentioned earlier that the minimum investment is $25,000. The other really unique feature of Leif that self-managed super funds in particular benefit from is monthly liquidity. That means that you not only have to have the ability to invest your capital for the longer term, but should you need to withdraw some money, or for whatever purpose, all of your money, it's available monthly. So what has Leif actually been able to achieve over the last couple of years in what have been fairly strong times for various asset classes? But it's been able to outperform equities markets in particular, so your more traditional asset class, in both 2020 and in 2021. And Anthony's going to talk a bit more about why and how we were able to do that. But this line chart here shows you in particular where in March 20, where the COVID crash took place and equity markets were down 30 and some other markets were down even more than 30%, LAIF was only down 5% in the month of March, and since then has been able to participate in the various rallies in various asset classes that have taken place. So when some asset classes underperform, others outperform, we've been able to capture that performance. And that's one of the strengths of the fund. One of the other things I just want to quickly touch on that I did mention when talking with Darren is that alternatives are not only an asset class that are being spoken about by many investors and typically only available to professional investors. It's also where you'll find some of the big super funds are investing their money, and also the future fund. What you'll probably find interesting is the future fund, for example, has about 45% of its portfolio allocated to alternative investments. And that is a fairly hefty weight for a fund like that. But then when you look at its performance, it's been performing an average of 10% per annum since inception, which is about where that is about 4% more than they're targeting to perform. And that is largely attributable to their allocation to alternatives. And the same could be said for a lot of industry super funds and how they allocate their assets. I think the next stage that you'll see on the bottom of this slide here is how the fund is allocated, the strategies that I mentioned earlier, the weightings that we've got to them. And that is because the investment committee does take the time to think about the themes, the types of investments that will make sense for those themes, and how we want to size our allocation to those investments within a theme. And I'll probably hand over to Anthony now to talk about a couple of those investments that we've made and the themes that we've identified and what we're doing to continue the strong performance of the fund.
Yeah, thanks, Michael. And just for the audience benefit of the pie chart that you can see on your screen at the moment, highlighting those different strategies. Obviously, within some of those strategies, for example, the long-short equities, we have a number of different funds at play. So currently right now, LAIF is running at 15 to 16 different underlying investment funds and or strategies within the portfolio. And at any period in time, we'd see that number oscillate somewhere between circa 12 to 18. So from that perspective, we want to have conviction in the ideas that we're taking. We've seen historically that the performance of many fund of funds out there has been quite underwhelming simply because they have too much diversification in there. And the real purpose of LAIF is to be a diversifier, but also complementary to other return profiles in the portfolio. I think when we talk about where we've delivered performance from, it's what's more important is the performance that we've been able to attribute over the last 2 years in particular is historical. So how do we continue to derive returns and make money for investors when we feel that the economic climate is going to be far less favourable for investors going forward? And we think that's going to be the case for quite a period of time. So if we think about capital preservation, that's probably really front of mind for us when we think about LAIF. And if you have a look here from when the fund started on December 1st, 2017 to where we are today, this highlights a negative marks that the ASX 200 has experienced over that period of time versus the performance of LAIF. And probably the two parts that I'd highlight the most that Michael touched on before, in particular, was March 2020, when the fund had a drawdown just over 5%, and the market during that period of time fell as much as 30% at one stage, but closed the month being down 25%. So being able to preserve capital when markets are extremely volatile and dislocating to the downside allows us to compound off a much higher capital base. And so we're able to preserve capital effectively during the COVID crash and do that well, and then grow off that much higher capital base than what equity markets were coming from. We then found our next stress test was in January this year. It felt like the market woke up at the start of 2022 on the back of a lot of hubris behaviour over the last couple of years. And there was that correction that everybody was expecting. So we're proud of the performance that LAIF delivered in January. Again, it was up 0.8, whilst the market was down 6.35%. At the time of this recording, it looks like LAIF's going to deliver a positive quarter for March of circa 2.4 to 2.5%, again ahead of the market, and that's primarily driven by that capital preservation period in January and that significant outperformance. And some strong returns again for the month of March. Where we're moving, where we believe as an investment committee, is into a very difficult economic environment. where we've got inflation that's really rampant at the moment. We don't think that's going away. We do not think it's transitory. The RBA has now done a backflip on their policy, monetary policy, and they are going to start increasing rates this year. They've been on the front foot about that in recent times. So if we think about traditional asset classes or passive investing has worked incredibly well for investors over the last decade, and we acknowledge that the rise of ETFs and industry super funds and pension funds as a whole. But that's all in the past, and we know that economic conditions are going to be less favourable. We know that companies are going to pay a lot more to borrow capital. And so as a result of that, how do we invest going forward? One thing that's been really pleasing for us with LAIF is, although we've been able to continue to get returns as good, if not better than the market, particularly over the last couple of years, we've been able to do that whilst reducing our correlation to the market. So our reliance on equity market conditions being positive. So you can see here that as the market has continued to rise, we've actually started de-risking our reliance on the market or our correlation with the market. And as Michael said before, that's by actually participating in strategies that have less reliance on equity markets. So, yeah, in investment circles at the moment, everyone seems to be talking about gold and resources and digital assets. Well, they're themes that we've owned in LAIF since early 2020, not 2022. So again, it's about being in front of the curve, not behind it, and identifying those emerging trends and then figuring out the best risk-adjusted way in which to own them. And that's really the ethos of LAIF. When we look at the annualized volatility as well, so I've just touched on the fact that we've been able to produce those returns by taking less correlation to the market. We'll also be able to reduce those double-digit returns on single-digit volatility, which puts LAIF on a Sharpe ratio of close to 1.4 compared to the market that trades at about 0.6, 0.65. So what that basically means is for every % return the LAIF is generating for you, you are taking far less risk than the ASX 200 in actually realising that return. And you can see of late that we've been able to keep that volatility pretty consistent in the last couple of years, which have been a highly volatile market, been able to keep that around 6 to 8%. Whilst the market's been trading around 14 to 18%, and we're quite confident with the underlying portfolio and how it's positioned that we can continue to generate those high single-digit, low double-digit returns with volatility of 6 to 8%. When we think about how we invest in LAIF, and there's a couple of examples we wanted to share with you today, we take a very much a top-down approach where first of all, we look at the macro environment. And once we look at the macro environment, we then look at specific sectors within the macro environment that we believe will outperform, but also sectors to avoid that we believe pose significant headwinds. So if you think about that over the last few years, one sector we identified really early in 2020 when the COVID crash happened was resources. And we wanted the portfolio to have a bias to precious metals and resources. And at the time, LAIF took the view that with the existing managers that were present in the market at the moment, we wanted to find a new strategy that could be very flexible and nimble and very active in what was quite a volatile market. So we partnered with a global resources manager and actually seeded the fund on day one. And that's one thing that our investors do get with LAIF, is that we back managers early, and quite often through fund management research, you'll note that managers tend to outperform the most in their early years. And LAIF has a mandate whereby I can support those managers early on. So we initially came into this fund on day one. We were one of only a few investors. It has a global resources mandate. It is incredibly flexible in how it can invest across markets within certain specific pockets of the resources sector, and can equally move out quickly without getting stuck. And you find with these larger managers out there that over time, they become liquidity constrained because they're too big, whereas our bias is towards supporting smaller managers that have more flexibility around their capital. And obviously the performance from this strategy since making that allocation has been very good, an annualised return of circa 64%. And we believe this manager actually has further room to grow. We recently increased our allocation to this strategy only about 6 to 9 months ago, because we believe there is further performance to be had in this resources super cycle. And another strategy is healthcare and consumerism. We spent some time with this manager in New York back in 2018, and at the time we knew this strategy was actually hard closing, i.e. not available for future capital.
And so we took the view at the time that we felt that the tailwinds within healthcare were going to be quite strong. So we took a reasonable position in this manager back in late 2018. And it's took some time for that to unfold. So whilst this strategy has had exceptional performance for us in the past 2 years, it was a laggard on the portfolio initially. And that's one thing to be very mindful of with LAIF. We promote returns of circa 8 to 12% per annum with lower volatility in the market, but over a 3 to 5 year period. We're looking for strategies that we think will emerge over a 3 to 5 year period as well. And we're happy to go into these strategies early with the view that that theme will unfold in time. And we've seen that here, and that's obviously really helped us with COVID as well. It's been a terrible event, COVID, but it's allowed sort of healthcare and pharmaceutical companies to do well, and also consumer discretionary expenditure. And this manager has benefited from that. What's more pleasing is that the healthcare index in the US last year actually was down for the calendar year 2021, yet this manager was still able to generate a significant return. You can put that down to their active management, avoiding companies and sectors of the healthcare and pharmaceutical sector that weren't doing well, and taking a bias in the portfolio to those that were continuing to perform well. Other strategies that we're looking to support in LAIF going forward at the moment include digital assets. We've been doing a lot of work on that, on the next wave in digital assets, particularly on the back of the success the fund has had over the past 2 years with a manager in Melbourne. We're very close to taking a small investment in I guess sort of the Web 3.0 phase within the digital asset space. We've also put on some hedging recently against the US dollar. A large portion of our portfolio does have USD exposure. And that is one thing to note with LAIF. You're truly having exposure to a diversified global fund of funds with circa 30 to 40% of the portfolio at the moment offshore, and we expect that to grow over time. So that's just a really brief summary from Michael and I about LAIF. The key points to take away is that LAIF is a supporter of themes as they're emerging. It provides liquidity in the alternative space. It provides retail and wholesale investors access to investment funds that are often only allocated to institutional investors, and we often get access to these funds at a significant discount from a fee card perspective because we are an institutional investor ourselves. If you have any questions regarding LAIF in particular, please reach out to our office, and thank you for taking the time to listen to this presentation today.
Thank you.